We've had lots of discussions of the one big beautiful bill, the tax impact, especially. What we haven't done in on the Wealthability Show is really go through some of the details and talk about how it specifically affects business owners, and whether you're small business or mid-sized business, how's it going to affect the entrepreneur, and what are some of the things you ought to be looking for, and maybe in some of the elections you ought to make. And then we're going to talk even about how much, when do these apply? Because some of them apply like right now. And fortunately, we have our good friend from the Tax Foundation, Garrett Watson, with us. Garrett, thanks again for being with us today.
Thanks for having me.
And just remind everybody, in case we have new listeners, a little of your background.
For sure. I work as the Director of Policy Analysis at the Tax Foundation, and we work on federal, state, and global tax policy, trying to educate taxpayers, policymakers, the media, anyone who has a stake in our tax system, to both educate on how the tax system currently works and to find policy recommendations and conduct research to make the tax system better, make it more transparent, efficient, and work better for taxpayers. And of course, I've been very busy in the last 6 months working on both the enactment and aftershocks from the One Big Beautiful Bill's passage.
Which is what we want to talk about, the aftershocks for the people who actually it affects, as opposed to the government, right? So, first of all, if you could, what would you classify as the top three provisions in the One Big Beautiful Bill as it affects business owners?
Right. So I think in terms of the policymaking goals for businesses, there were a couple of things that they want to prioritize on the Hill when this passed. One, of course, the big thing shadowing this whole law was the what was then the looming expiration of the 2017 tax cuts, which impacted not just individuals, which are expiring all at the same time at the end of this year, but also businesses. Right. There were changes not just to rates and brackets for ordinary income, for example, but also the expiration of the 1INA deduction for pass-throughs, which was a 20% deduction for qualified business income. That would have been a pretty big increase in effective tax rates for businesses. We also had, over the last few years, a slow burn of either full expirations or a path to expiration for several business provisions, including 100% bonus depreciation, which allowed for immediate deduction for short-lived assets, which was phasing down by 20 percentage points a year through the end of 2026. We saw a reversion from R&D expensing to amortization over 5 years for domestic R&D investment. We saw a tightening of the interest deduction limitation in that law. That was all scheduled as part of this 2017 Act, and there had been a prioritization by policymakers to reverse these, to bring back bonus depreciation, bring back R&D expensing, make the interest limitation more generous. They tried to do that a couple years ago on a bipartisan basis. That had not happened, and that was another thing they wanted to address in the law. Both of those items did happen here, which we can get into more details on how that'll affect folks moving forward. So those are two pretty big changes. And then the other, of course, set of changes were, one big priority was to try to increase incentives for domestic investment in the United States. That was, as we all know, for better or for worse, the big priority of the president during the campaign, and something they wanted to continue in this law. And so we saw several new provisions come on board, including an interesting deduction for certain qualifying structures, for example, that business owners should be aware of if it affects you and your investment. And we also saw, of course, some other changes on the other direction, right? The biggest of which was the rapid phase down of the clean energy credits that were expanded as part of the 2022 Inflation Reduction Act. That was one of the largest revenue raisers on the tax side in the law, and will have immediate impacts on business owners who are working in that space that we can get into as well.
So let's start with what you and I have talked about before as maybe one of the most important provisions, which is the bonus depreciation. So bonus depreciation was enacted in 2017 as a 100%, and it covered not just new assets, but also covered used assets. And it didn't even cover just personal property, but it actually covered some real property, like leasehold, like improvements, land improvements. So anything under that 20-year life. So kind of walk through, is there anything different that you see between the 2025 bill and the 2017 bill, or are they identical with the exception of the phase out?
Yeah, so the priority there, and it has been sort of in the policy debate, was continuity with that existing design. So a lot of that is going to be fairly familiar for folks who have taken that 100% deduction for those depreciation allowances moving forward. Of course, there's going to be some interaction with, the existing, phase down, as you just mentioned here, but generally speaking, there's continuity there. One quick note, and this gets into the sort of the structures expensing provision is some stuff that could qualify under that actually may qualify under a bonus already. So you'll want to check on that. That is one technical note that if there's certain in our investigation, there may be certain cases where there may be a structure that's more shorter lived. Thinking things like grain silo, for example, that actually is in that 20-year or smaller life that you just want to coordinate on because you probably only take one or the other, and there may be planning reasons you want to take one over the other. We can get in more detail on the structures depreciation piece, but that adds a little more complexity on the calculations here and the planning with respect to
Yeah,
bonus.
so let's talk about that because there's been the confusion since 2017 is when would I ever take a 179 deduction? Because the limits on section 179 deductions went up under
That's
this
right.
bill.
That's right.
But the question is, when would I ever take the 179 deduction? Wouldn't everything under 179 also be under bonus depreciation?
That's generally true. There may be some edge cases or exceptions here that you could look into, but for the most part, there is a lot of overlap. And so, and to some extent, that's like, I mean, on the one hand, that actually is simplifies things for a lot of taxpayers who may otherwise, need to determine if there are, areas of overlap, but then areas where they're not overlapping, that would be more complicated. You'd have to look into that. But if it is mostly duplicative here, you could just take bonus and call it a day.
And one of the reasons you'd want to take bonus, of course, is that 179 has different recapture rules
That's right.
than bonus depreciation. Bonus depreciation actually has, I think, more generous recapture rules. In other words, if you take it out of service, you don't recapture it with bonus. But if you like take it from business to personal, you do have recapture under section 179. So it seems like business owners are going to want to really focus on bonus depreciation. Did they do anything under 179 to change the 179 rules or the bonus depreciation for trucks? Because trucks and vans and SUVs, that's been a big issue. Because of course they changed the rules under 179 so that you don't get you have to meet certain rules, not just the weight anymore, but it has to be used solely for work, and the bed has to be so long, and you can only fit so many passengers. Is that the same case under bonus depreciation?
I believe I'm more familiar with those rules with respect to 179. I'd have to go back and check myself to see if it's different or more generous under bonus. But that's an important note. I
Okay,
think
well,
we'll check into.
then here's what I'll tell everybody. So I'll actually do a video on YouTube separately
Yeah, I mean,
on the ones on specifically the cars and trucks because I
yeah.
think that's a point of confusion for people, and frankly, I have to look at it every single time because they've kept changing the rules. It
Mm,
used to be pretty simple. You're over 6,000 pounds. It's an SUV or a truck, and you get
that's right.
full 179, but that's not the case anymore. So now they've got all these other rules in there in 179. So then the question is, well, what happens under bonus?
Mm,
Because bonus depreciation has some similar tests, right, on that 6,000 pound rule. So that's going to be one that you're going to want to look at. And like I said, I'll put a video out on YouTube specifically talking about that. So that's the big expensing rule. And I do think that most people will want to use bonus depreciation more often than they use 179. Let's talk about this qualified production facility because I really think this is a cool provision. I
mm,
really like this one. You and I have talked before. We both like bonus depreciation, but I like this because it's basically a manufacturing facility, but you're
right.
actually getting bonus depreciation effectively on the actual structure, right?
That's exactly right. Yeah. So this is under, I think it's 163N, and it will provide a 100% depreciation deduction for qualifying structures that are associated with tangible production. So it will be in, manufacturing. It's sometimes colloquially talked about as factories, though it does not literally have to be a structure that you would commonly know as a factory. Where and the sort of in the law, they try to be very specific about what they meant by tangible production facilities. And of course, the IRS and Treasury will have to give even more detailed guidance on that, consistent with the intent and writing of the law. But that's the idea here. So, if you have a structure that is not associated with tangible production in that way, you may not qualify, but it is meant to be fairly broad otherwise in terms of that tangible production use case. There are a couple of exceptions there. For example, one that came up quite a bit in the past when this was done before, variants of this have been provided for before, was if you are in, let's say, fast food, or a facility that's providing food as a service, that's actually been excluded because often they were able to qualify there. So there are certain exceptions like that where but it is a little different in that it's tied to the use of the structure. The one thing that we know, both from talking to folks at Ways and Means and others who are working on this, and this is one thing that came up I think in the discussion about the policy design, is to what extent will this make more complex or add more sort of challenges to, say, cost seg with respect to bonus, or other planning for other types of deductions. And the intent anyway, was to make that as consistent as possible and as simple as possible. We'll have to see, and I mean, it's going to be really, I think, battle tested here in the next year or two, if that's actually true in practice, if there are issues that come up that need to be ironed out either in regulation or worst case scenario, some sort of technical amendments to this. The last thing I was just going to say is this is a temporary provision. So unlike with bonus, which was made permanent, R&D expensing, the interest deduction limitation changes, it does have a finite runway. So basically,
so when does it expire?
Yes, it applies to any structure that began construction after January 19th, 2025. And is beginning construction before January 1, 2029, and it has to be placed in service before January 1, 2031. So you're looking at a 5-ish year runway. There's some obviously construction and placed in service, but that's and the last thing I'll say is, like, the intention here, I think, is very much to try to extend this and make it permanent in the future for advocates of this type of idea, to try to encourage investment.
Well, we'll see if it works, right? I mean, one of the reasons that I see for making something temporary is to see, does it actually work?
Right.
Right. And if you make it temporary, then you do have a rush to do it. So there is an additive, a time limitation, right? There's some urgency to it that there wouldn't be if it were permanent. Mm-hmm. And so I think there's some emphasis there. Now, in the original House bill, I believe that there was a limit on on which companies could use it. But in the final bill, it seemed like it was unlimited.
I think that's generally right. Yeah, in the original sort of House design, they were going back and forth on certain limitations with respect to, foreign companies or companies that are connected to China, for example. There were some limitations there, but it's much more open-ended, I believe, in the final version that was passed into law. And so we have heard a little bit, and something we're investigating more from some practitioners and folks who just work in this space day to day, is one caveat is, okay, this will be great for folks who already, maybe they have a building planned here and are just getting started in the next year or two. That's great. There may be some limitation, and to the extent that these plans have a long tail, and 4 or 5 year runway still isn't enough, which I think is fair, right? Like a permanent or a longer tailed design might be more beneficial for these types of investments in particular, right? But to whatever extent that actually is a problem, we'll have to see in practice. And of course, the other thing, which we remind people all the time, is of course there's going to be some limitation in the true value here if you don't have income to offset. So of course, that's the other.
Of course,
carry forward. There's always other options there, but that's another caveat.
Sure. Now, a couple of things that I noticed in it. First of all, is that it excludes office space. So if you build a manufacturing plant and you've got office space in it, the office space doesn't count. So you have to depreciate that. So now you've got this cost segregation where you're actually doing a piece. It's almost like the reverse of the home office, right? Where the home office would be a piece of your home that you could, do a cost segregation technically, and then the rest of the home you can't. This is the kind of the opposite, because usually the office space is smaller. The other thing that came up, and I don't know if you've addressed this, something that we're looking at is it seems to have to be used in manufacturing by the taxpayer. So a lot of companies do a sale leaseback And it sounds to me like that would not qualify. Have you looked into that at all?
Yeah, I didn't go back and see if there's any details in there, but I think that that's right, and that might be an example of a use case where it would be better to to have it changed to reflect that, because I think the if that is missing, it's not, I'm fairly confident it's not because the underlying intent was these lease backs are not shouldn't qualify for a policy reason. It's just because they didn't think about that interaction
Got
at
it.
all.
Got it. And that's why it seems to me that maybe this is a technical correction, and
Yeah,
maybe if we do get another bill next year, the end of this year or next year,
that'd be a place
they'll
to put it.
include some of the technical corrections in there. Unfortunately, we keep thinking we're going to get technical corrections, and we haven't in the last 8 years.
Right,
So
right. Chris, how long did it take for us to get a quick correction in 2017 law? I'm trying to remember when that finally happened. Was that 2019?
it
Was it
was a
earlier than that?
while. It was a
Yeah, it
while.
was a while.
It was a while. I have a question for you. This is a very technical question. It's a little nerdy question for those of you listening. Question is, are we going to get a blue book on this?
That would be the ideal. I've not heard one way or the other on that. Of course, I mean, the IRS and Treasury are just scrambling to get just basic guidance out right now on all, not just the business stuff, but on all of this. That because as we were talking about before the show started, right, a lot of these provisions do kick in, as we've talked about, in 2025. Some kick in 2026, and so they know there's going to be a lot of disruption in the tax season at the beginning of next year in the spring. So just setting up taxpayers for success just for that is probably their primary priority, especially with a lot of
Yeah, and yet the blue
the
book. So
IRS.
so 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 I'll explain to everybody what the blue book is.
Yep.
The blue book is the explanation of the bill by the staff of the Joint Committee on Taxation. The staff of the Joint Committee, they're basically from the House Ways and Means Committee, the Senate Finance Committee, and they get together and they actually say, "Hey, this is what we meant," because they wrote the bill in the first place. Now, this is a weird bill because the House passed the Senate version. There was not really a joint committee that worked on this. So that's one reason I asked. But why this is important is because typically Treasury and the IRS, they write the regulations from the Blue Book,
Right.
not the other way around. The Blue Book comes from the staff of the legislators, right? And so they're the ones who kind of know what's going on. And while it doesn't have precedential value, it's really a really good indication of what was intended. And we saw it, for example, in the small item expense, in the inventory expensing of the 2017 bill, where there was a footnote in the blue book that said, "Hey, this is what this means." And the IRS originally wrote regulations that were contrary to it and went back and fixed them
Mhm.
because of that footnote. So I actually think that's something important, and make sure when you're talking to your tax advisor that you ask them, okay, have you checked the blue book on any law? Frankly, we don't get one on every law, but normally on the big ones we do. So hopefully we'll get a blue book on this one.
Yeah, I have to go back and see when we got one for the 2017 law.
It was pretty quick.
Yeah, it was quick. We did get a very not quite a blue book, but it was a pretty detailed list explanation anyway of the underlying bill text for the House version. It was a couple hundred pages long from JCT. We did not, and that was of course because JCT was much more involved in the
House,
production and the estimation ahead of
right?
time with Ways and Means than on the Senate side, which was cobbled together in a much more um, in a quicker fashion during the legislative process. But I wouldn't be surprised if we got one here soon from them. If anything, because it will help inform the process that both Treasury and the IRS are dealing with
Right.
right
Right, exactly. All right, let's go to research and development expensing because this was a big deal. We thought everybody, including Congress, thought this was going to be that this 5-year phase out was cliff. It was not going to actually happen. Everybody thought, well, they'll extend it in 2022. They won't let it actually they'll actually, and they'll do it retroactively. They'll make sure that we don't actually have to capitalize our research and development costs. And then we had several businesses that, I mean, I can tell you that some businesses were paying as much as 80% tax on their cash flow.
now.
And so that's like using up most of their cash flow just to pay tax because of this capitalization. So it was a terrible, terrible provision in the first place. But the big, beautiful bill, first of all, makes it permanent, right?
That's right.
which is
permanent
nice.
expensing.
It's
It
now
applies just to domestic R&D. That's the other
just
caveat.
domestic, not foreign. And this is another January 20th provision, right?
That's right. Yeah.
Actually, actually it is, but then it goes retroactive. So can you
That's
explain the
right.
retroactivity part of it?
Yeah, so our best understanding of the retroactivity part is for, and it's divided up between small businesses as defined with gross receipts of 31 million or less. So for those folks, they can retroactively expense R&D back to anytime after 12/31/21. So anything after that, it can be retroactively applied. And then all other domestic R&D between 12/21/21 and 1/1/25 can accelerate. You can accelerate the remaining deductions over a 1 or 2 year period for businesses above that threshold. So yeah, a couple moving pieces there, but yeah, the intention is to try to provide some of that
Yeah,
retroactively.
and then they also gave the IRS gave us some options, right? So at least for the small guys that they're instead of having to go back to 22 and 23 and file amended
Yeah.
returns, et cetera, we actually can pick it up all in one year. We believe they meant 2024 if you haven't filed your tax return yet, but if you have filed your tax return, then you could pick it up in 2025 if you wanted to instead of going back.
Yeah, that just makes a lot of sense from a taxpayer perspective than requiring them to go back and amend each one
Well,
of
and
these.
from an IRS perspective too,
And from
frankly,
their, yeah,
much
exactly. Easier on
easier for
them.
them
Right.
as well,
Yes. Yes.
right? And of course, it changes all the budget computations and everything,
Mm,
right? Because what year does it apply to, et cetera, et cetera. So
right.
that's always interesting. Now, a couple of things that people probably are less aware of. One is the change in the interest expensing. Can you kind of walk through that provision?
You're referring to the interest deductibility limitation. Yeah.
Right.
So basically the 2017 law created a new limitation on business net interest deductions. And so and that was paired, with some of these expensing changes that we were referring to before, right? So the limitation before was, 30% based on your EBITDA. And that took effect starting in 2018 and then through, I believe it was the beginning of 2022 because it lined up with the R&D amortization. And so that was, and there's some interesting legislative history on all this too, where basically one house wanted one design, one house, the Senate, I believe, wanted another design. So they just decided to we'll do both and just temporally cut the date at 22. That's how you end up with these two different designs. So the EBITDA-based limitation at 30% of net interest deductibility from 2018 to 2022. And then beyond that, it was tightened to EBIT. So dropping the depreciation and amortization value with respect to the 30% limit, that mechanically means there's just fewer net interest limit deductions you can take, basically calculated as
Right, it's a
30%.
big deal because if it's EBITDA, that means you get to add back
Right.
depreciation and amortization, not just interest and taxes, but depreciation and amortization. And if it's EBIT, then you don't get to add that back. So there was actually an incentive not to take bonus depreciation, for example. There's incentive not to expense certain things, and now they've made this one permanent, right?
That's right. So they reverted back to the EBITDA based limitation, 30% here, and that's permanent moving forward. So it's making that a bit more generous. It's also one thing we noted a lot in our work, the internationally recognized standard to do this kind of thing. For if you're going to have an interest limitation, it's almost always defined under EBITDA, caveats on, if there's any differences in financial accounting between countries. But that is the more typical standard, and that's what we went back to.
That's good. Now, presumptively, the reason for the limitation is to make borrowing more comparable to equity,
Right.
right? Because interest is deductible and dividends are not. And I'm just going to throw this out there. Do you think we'll ever get to the point where we actually get to deduct dividends, which would be the much better answer?
That's right. Yeah, having a dividends received deduction would make a lot more sense to help level the playing field here between debt and equity. That's always been because the other sort of temptation is just try to limit or get rid of interest deductibility, which I think has an uphill battle for a lot of reasons, right? For
Right.
taxpayers, policymakers alike. You can do other fancy things that we've looked at, right? You could change both the treatment of interest deductions and the tax treatment of interest paid, but that has a lot of complexity and nuances here because not all interest is taxable, right? So you end up with like the going back to the cleanliness of a dividends received deduction looks a little more attractive.
Yeah, and I'm actually more of a fan of a dividend paid deduction than a dividend received
Yeah,
deduction.
yeah, you go
So,
that
I mean, so let Apple get a deduction for paying dividends,
right,
right? If it's going to be picked up in income, and then pick it up as ordinary income. You don't have to pick it up as capital gain at that point. At that
mm,
point, you can pick it up as ordinary income. So I think you can
right,
offset the loss to the fisc by
hmm
making that ordinary income instead of capital gain. And all you have to do is make it deductible. Do you think that would, I mean, I presume you guys have looked at this. Do you think that would encourage payments of dividends? It would certainly, you know, make it more beneficial to them. Do you think it would actually make a difference?
Yeah, I think on the margin, especially in the short to medium run, it would definitely make dividend payments more attractive if you did it that way at the entity level. And so I think that would, I have to think about a little more about like the longer term effects in equilibrium if things shift a little bit. But I can't see to the extent that you're motivated by trying to get more sort of payments from firms to shareholders that could be reinvested elsewhere. That's going to be and that's come up off and on in the federal debate sometimes about how to treat, retained earnings and the concerns about things, related debates about things like, buybacks, for example. So I think
Right.
that could be an upside to that kind of idea.
So let's turn to the renewable energy subsidies, okay, that got killed here. Can you kind of walk us through what they actually did?
Oh, sure. So there's a lot of back and forth here, particularly in the Senate, on how to balance the desire amongst many Republicans to either fully eliminate immediately or very quickly as possible phase out these credits, while also, being very aware that you have a lot of taxpayers, individuals, but especially businesses who are making
They're
really
in the middle
important
of
investment and
projects.
planning decisions.
They're
What's that?
in the middle of projects.
Exactly. And so they need certainty and don't need the rug pulled out from them if contributing to the economic environment at this point. And so they try to balance this and went back and forth a lot of different ideas here. But I'll give you a quick summary of what they did. And the one downside is that it sort of varies based on the credit. So you really want to be very, very detail oriented on depending on which credits you're claiming or think you might claim, what those rules look like. We can get into in a minute the additional sort of little bit of regulatory uncertainty after the fact on certain rules as well. But to the letter of the law, anyway, the idea was for the clean electricity production credit, that's 45Y, and the investment credit, that's 48E. Those are two big ones. That's eliminated for projects placed in service after 2027. So there's like a two-ish year runway there.
And
That's accepting.
that includes like solar panel credit.
That's right. And there's an exception here for projects that begin in construction within 12 months of passage, and it also excludes baseload power sources. So, not what you just referred to, but things like nuclear, hydropower, geothermal, battery storage, stuff like that. There's also the other thing, which was pared back a little bit, but still, I believe is in place, is certain restrictions on foreign entities of concern or FIAC rules. That may not apply to a lot of, business owners listening to this podcast, but that's a new set of rules that are added in. The clean fuel production credit 45Z is extended until 2030, and they actually expanded eligibility for that a little bit, which was interesting. And there's additional sort of qualifying income tests that were added in for hydrogen, carbon capture, and nuclear as well. But the general idea here was to give a couple of year runway and then cut them off. The one thing that had come up, of course, was when it comes to safe harbor rules with respect to construction, there's back and forth with folks in the House who were worried that that would be used as a loophole to extend claims of these credits beyond what was intended. And so they've been working with Treasury and the Trump White House, who are been also going back and forth on how they will be interpreting that what it means from that perspective to begin construction to avoid gamesmanship where you could do the bare minimum and with the intention of just claiming the credit to help phase it out. So that's something to watch closely though on that guidance if you're a taxpayer in that situation.
So the one runway they made really short was the electrical vehicle credit.
Yes.
Can you
Yeah.
talk to that?
I believe that's through the end of the year, right? And then it's just done. I believe is that right? Or I don't know how
I
to have
don't
that.
think it's that long.
It may be sooner than that. Yeah, I thought it was.
I think it's done. If you can check that real quick, I
Yeah.
actually think that's done really quickly, really shortly here.
Yeah.
I think they did it within the year.
Yeah, I think that's right. The end of this year. I believe it's the end of 2025
Okay.
is what I was thinking. Let me just confirm that here. Actually, it might be sooner than that.
I
Looks like
thought
they're
it was.
end of September 30th, 25 is what I'm
That's
reading.
what I thought. It's the end
Yeah,
of
yeah.
this
So it is sooner
budget
than that.
year. It's the end of the budget
End of the
year.
budget year. Okay, that might be why I saw it was fiscal
Right.
year 5.
That,
That
that
makes
that's what it is. The end of this budget year. So it didn't go into the next budget year, but it didn't affect this year's budget. So that's a big one.
sense.
So if you want an electric car, make sure you go out and lease one between now and the end of the year. I understand the end of September. I understand that the deals are really good right now on
Yeah.
these. Really good because they're very concerned that they're not gonna have them at all. That they're just people of the early adopters have all bought their cars, and it's going to be a slow burn after that. Anything else that kind of struck you as particularly important from a business provision in this new bill?
There are let's see here. I think we hit the big ones. There were a couple of changes, of course, to charitable deductions. One of which was on I think just on C
Corporations.
corporations. So it's a 1% floor on the deductibility of charitable
Yeah,
contributions.
1% floor and a 10% ceiling.
That's right. Yes, exactly. So now we have it on both ends here, and it's actually somewhat substantial for some, especially bigger C corporations.
Right.
Our estimates, the Joint Committee found it's about half the value of those charitable deductions will be cut due to that just that
Wow.
1% floor.
Just that 1%.
Yeah, because the average of it, apparently, a deduction as a portion of income there is just short of 1%. So that might explain why they picked 1%.
There you go. What about the qualified business income deduction?
Oh, yes. Thanks for reminding me on that. So that was the other, of course, as I mentioned earlier, big provision that there was a lot of prioritization made on extending and or making permanent 199A, right, which gives that 20% deduction for pass-throughs. There was in the legislative process some changes where they actually, in the House side, had not just made it permanent, but increased the value to 22% deduction. They also had changed, in some somewhat confusing ways, the ways in which the phase outs work and the for the
That
limitations.
was very confusing.
Yes, thankfully that got sort of stripped out in the Senate version that passed into law.
Thankfully, that was scrubbed.
Uh, yes, and so
Was
that
that
ended up being passed. So there's a 20% value kept in place, made permanent. They changed the phase in, I believe, to the phase in range of the limitation by $50,000 for non-joint returns and $100,000 for joint returns, and so that will.
so that much higher, right?
That's right.
So you can have
So
a little more income, but it's still not adjusted for inflation, is it?
it's not, yeah. So that's well, I have to go back and
I don't think it is. I think that one's not
never.
adjusted. I couldn't. I don't
I don't
remember
think it
for
is.
sure,
Yeah,
but
just
I
looking
don't think
back
it
on it. There were
is.
a lot of adjustments we had to make in our modeling, so I was trying to remember if that was one. But yeah, the idea there is like there are a lot of like spikes in marginal rate effective rates when you have that tight sort of window of income when you hit the limitations, and so they expanded it a little bit to help with that. And it also one thing might miss people's radar, but it also created a minimum deduction of $400 for taxpayers with 1,000 or more of QBI for folks who are material participants. So small little bonus there for some folks. It's just a footnote, but
It's interesting. So this is for the side hustle, right? That's what
yes,
it's for.
I think that's basically who it's for, who will be most benefiting from it.
Yep. Yep.
Uh,
It's for the side hustle.
yeah, but the
So
biggest thing is continuation of that deduction.
final words on, if you're a business owner, what do you think? What do you do, and what do you have to be concerned about?
Yeah, I mean, for some folks, I mean, it's an interesting time because I think for businesses who are tuned into this, this policy world, which may be a minority of them, of course, they may have expected some of these changes that are coming into place. Maybe they expected it sooner, right, with reversion of bonus and R&D, and so they may be actually pretty well set to take advantage. And there's only some details that need to be dialed in, particularly as we get into next spring. For others who maybe didn't expect this at all, it might have some really big material benefit, as you mentioned earlier, right? Changes to cash flow and planning there, needing to adjust for any retroactive changes. And so staying on, I mean, this is sort of common sense advice, but staying on top of those changes, being really detail oriented there, working with tax professionals to make sure to take the full benefit in this first tax season is really important. That's the transitional years are always the ones that are the trickiest, where you might miss something. Especially, of course, it's a combination of things that are continuing or were in place before that folks will be familiar with. And there are some new items here we just talked about. So that's making sure to hone in there is going to be important. And hopefully, I mean, fingers crossed, we will get that we've already started to see some of it, but more of that IRS and Treasury guidance, so folks don't feel like they're lost heading into the tax season.
No, and I think the other thing is to look at the effective dates, right? Because I think the effective dates are a pretty big deal here, because a lot of them they picked inauguration day, which I get a chuckle out of that.
You wouldn't have guessed that one, right? Yeah.
Right. They picked inauguration day. Others really are actually next year. So,
Right.
and then we have others that, like you said, for the clean energy credits that expire down the road. So, something you do have to. The devil really is in the details. You really have to do the run the numbers. Things like, do I take bonus depreciation, or do I take 179 expensing, or do I take regular depreciation? You really have to run the numbers, because what happens is, it's one thing to understand the concepts, which is important, but it's very important that you work with a tax advisor that you run the numbers with, because when you actually get down to it, it's what matters to you and your situation that makes the difference between whether you pay more or less taxes and make more or less money. But the reality is that the more you understand and the better tax advisor you've got, you're going to make way more money and pay way less tax. We'll see y'all next time on the Wealthability Show. Thanks, Garrett. Thanks for listening to the Wealthability Show. If today's episode gave you a new perspective, remember this: the tax law is not your enemy. It's a roadmap. And when you know how to follow it, you can build real, lasting wealth. If you're a business owner or investor who's tired of overpaying taxes, the Wealthability Accelerator is your next step. You'll have the opportunity to work directly with me for 80% less than my standard rate. And I'll personally guide you through how to change your facts so that you can change your tax. Go to wealthability.com/bonus and apply today. Remember, it's not just what you make, it's what you keep.
This podcast is a presentation of Rich Dad Media Network.